7-day winning streak on the S&P 500, live from New York City this morning. Good morning, good morning. Equities just a little bit higher on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, equities on the longest winning streak in 2 years. Looking to see if Chair Powell spoils the party as the Treasury braces for another big test. We begin with the big issue. Will Chair Powell spoil the rally?
Markets have sort of reset their expectations with how much of a headwind central banks are going to be.
The stock market rallied because the bond market rallied.
This move has been a well-deserved sigh of relief.
There's a bit more reason for investors to be a bit more optimistic.
At the same time, we're seeing that interesting dynamic where central banks are actually not that happy about it.
It might complicate the Fed's process for trying to rein in inflation.
Financial conditions need to remain fairly tight for them to achieve their goals within a timeline that's acceptable.
The Fed is going to maintain this message of higher for longer, which means higher for longer.
They allegedly aren't even talking about rate cuts.
They're not even thinking about rate cuts at this point.
We are seeing some evidence that the economy is indeed slowing.
Inflation is back.
Inflation's not where it needs to be yet.
I don't think any central banker will want to declare victory on inflation.
The Fed needs to be very, very cautious.
Joining us now to discuss JP Morgan's Kelsey Barrow, Darryl Cronk of Wells Fargo. Kelsey, first of all to you. We'll hear from Chairman Powell a couple of times in the next 24 hours. Are we expecting another rendition of 550 ways to proceed carefully?
So I don't expect a lot of changes from Chair Powell's message today or later in the week. The Fed is data dependent right now. I mean, they're focused on inflation. They're focused on the jobs data. So here's what I would say. The market is going to trade a soft landing until proven otherwise. The Fed, on the other hand, they're going to be focused on, is inflation continuing to come down and is job growth continuing to moderate? The September payrolls report was a real cliffhanger. There was a question around, is job growth actually reaccelerating? I think the October jobs report last week really built some resolution into that question. The jobs market is still cooling. Job growth is still slowing. The unemployment rate is actually ticking up. And on the inflation side, I was noticing the New York Fed's global supply chain pressure index. It's at the lowest level in the history of the index, lower than it was at the GFC. So as long as inflation continues to come down and the jobs growth continues to moderate, we're in a soft landing until proven otherwise.
Kelsey, Neil Dutta, Renaissance Macro, said the labour market no longer a reason to be hawkish at the Federal Reserve. Would you agree with that?
The labor market, you said?
Yes.
I would agree. I think you've been seeing signs of cooling in the labor market now for a number of months. The unemployment rate is gradually rising. Job growth is gradually slowing. You know, some of the other things that I look at under the surface, hours worked. So if this is an economy where companies are more concerned about laying off people that they spent a lot of time and effort to hire, you're going to see the weakness in the labor market come from hours worked rather than layoffs. And that's actually what you've been seeing. Hours worked has been declining. And also those temporary jobs, temporary help services has been very weak for a number of months. So I think the Fed can feel good about this moderation in labor demand and supply continuing.
Darryl, just to build on that, to Kelsey's point, in the labor market, we have seen this ongoing rebalancing. In your mind there, do you think this Federal Reserve is willing to tolerate the easing of financial conditions we've seen over the last week?
Yeah, it's a good question, John. I would say, look, the central bank and particularly the Fed, I think, is agitated right now. I think they wanted to deliver a message of a hawkish hold last week. The markets interpreted it as a dovish hold, basically. If you believe that the yield curve was doing the work for the Fed in additional hikes, then as rates come down, you have to also concurrently believe that it's not doing the work of the Fed anymore. So I'm not convinced the Fed is fully done yet. What I am convinced of is the market has far too many cuts priced in for 2024 at this point. We just don't see that happening. And if you think about it and you reverse engineer this, the fastest way to rate cuts from the Fed is what? A recession, right? And so this idea that soft landing sits side by side with aggressive rate cuts next year, or even rate cuts, period, is not something the Fed's considering. I think, to be candid, John, I think 2023 was all about inflation, was the straw that stirred the drink, and Fed rate hikes. 2024 is going to be all about the performance of the real economy and where it goes.
Well, you say too many rate cuts are priced. Kelsey Barrow, 2024, are too many rate cuts priced?
I'm not sure that too many rate cuts are priced. I understand the concept that if the economy continues to show resilience, then the Fed is going to continue to communicate that policy should remain restrictive. But the market prices things on a probability-weighted basis. So yes, there may be a 50%, 60% probability that the Fed can stay on hold all year, but there's also a probability that you get a recession. And in a recession, we know that the Fed cuts very quickly. So I actually think that there is justification for the market to be pricing in some cuts next year. And then when I think more broadly about what the Fed funds futures curve looks like, it actually shows that a Fed that isn't going to cut rates below, let's just say 375 for the next 10 years. I actually think that's quite sanguine. I think the market and the economy is still sensitive to higher interest rates. And ultimately, I don't expect that type of sanguine view for the policy rate to stay above 4% for the next 10 years is really likely.
The bonds are fairly stable this morning for once. On a 10-year at the moment, yields just about unchanged, down a basis point. Let's call it 4.56 on a 2-year. Up a single basis point on the 2-year right now. We can call it about 4.93. Tons of Fed speak on the calendar. Mike McKee, we'll hear from Chairman Powell today, right? And tomorrow again.
Yes, we will. Will it make any difference? That's an interesting question. Your guests have been highlighting the difference between the bond market and the Fed. To talk about that, I'm going to point out that the bond market has now priced in very aggressive cuts, as you say, and I can explain it through the words of one of the greatest coaches in Premier League football history, Ted Lasso, who said, the happiest animal in the world is the goldfish. It's got a 10-second memory. Be like a goldfish. That's the bond market right now with the data and Fed speak. Because you look at what the Fed has been saying, and it's completely the opposite. Neil Kashkari sat down with us yesterday and said, 3 months of data may not even be enough to convince me of where we are and where we're going. And several other Fed officials yesterday gave essentially the same message. It's a very, very uncertain time, and they don't know what they're going to do yet. And so all this gyration that we're seeing in the markets doesn't mean very much to them. There is one point that is also addresses both of those, and that would be Deutsche Bank's Henry Allen noting that this is about the 7th time now since the Fed started raising rates last year that the bond market has pivoted in its expectations of the Fed. And this time it's because they're thinking, well, we've gone down and now that's going to loosen financial conditions and that's going to make the Fed's job harder. So do you want to be a goldfish or not? Maybe not. The Fed is going to be looking at all of these data points coming up, and they're going to look at the longer run horizon more than 10 seconds. So it's a long way of saying maybe we don't want to worry too much about what the bond market's doing right now.
Mike McKee, thank you, sir. I'm so pleased you did that. Darryl Cronk, Jim Caron, Morgan Stanley on this program yesterday talked about how quickly we've gone from the big bad wolf in the bond market to Goldilocks, just like that in a week. How quickly can this narrative, Darryl, flip back?
I think very quickly. I mean, the reality is you had a lot of hedge fund and CTA positioning that was offsides, net short, that had to cover quickly when we broke through some technical levels last week. The long side of the yield curve created the equity market rally. Looks to us like it's a bear market rally and not something that's sustainable. Remember, the cause of last week's rally on both fixed income alongside the curve and the equities was a less than anticipated QRA coupon funding, a Fed that was perceived dovish when it should have been perceived hawkish, or hawkish hold anyway, and frankly a weak unemployment number. So I think you can unwind this very quickly, and I just would remind everybody, John, that yes, it was a huge move last week, but we're back to exactly where we were on interest rates and on equity levels when we were in mid-October. So literally a couple weeks ago. We've done nothing but round trip this thing from the big bad interest rate move on the 10-year to 5% back down to 4.60 this morning, which is where we were on October 15th, 16th, 17th.
Kelsey, what can you point to that makes you think this move is sustainable?
So at least as it relates to the rally in yields, the move lower in risk-free rates, I think that this is sustainable primarily because we do believe that the Fed is done hiking. Now, I don't expect that central bankers at the Fed are going to admit this anytime soon, but I do think that the trends in the things that they care about the most, the inflation trends and the labor market trends, are supportive of them keeping policy rates restrictive, but not necessarily going higher from here. And we do know that in an environment where the Fed is able to sustainably pause, we should be seeing yields moving lower, because if the next move isn't up, then we're thinking about when the next cut is going to come. And I know that the Fed is not talking about cuts yet, but we also know that the market moves very quickly. And right now, we've seen a lot of resilience in growth, particularly Q3. It's all being relied upon the consumer to hold that up. If we start seeing those cracks in the consumer show up more readily, that's when I think the market will get more nervous.
Well, Kelsey, to that point, your long-running call for lower yields, does it require from here not just rate cuts, maybe next year, but ultimately materially weaker economic data into year-end and beyond?
So I don't necessarily think you need materially weaker data to get stability in yields and a drift lower in yields, but to get a real reaction from the Fed where they're no longer on this more neutral to hawkish bias, but they're actually thinking about easing policy. Yes, you need to see non-farm payrolls falling below 100,000, and you need to see the consumer starting to struggle. We're definitely seeing that under the surface, particularly for lower income, younger cohorts. Delinquency rates are not just rising back to pre-COVID levels, they're actually drifting above pre-COVID levels. But overall, if we're not seeing that in the macro data, we're not there. And so for now, it's a soft landing until proven otherwise.
So, Daryl, it's a soft landing until it's not. And this is what Peter Chia of Academy Securities was talking about earlier on this morning with us on Bloomberg Surveillance. He thinks there's a 3-week window here, maybe a month, where you can be constructive. And ultimately, perhaps yields can move lower from here down to 430. But his point is the following, that you can take some enthusiasm and constructive view from a shift lower in yields, but at some point you start thinking about why they're lower, why we're talking about rate cuts. And ultimately, it's got to be because the economic story is not as good as it once was. Does that mean for you, Daryl, even if we do get this continuation of the move in the bond market that we've seen over the last couple of weeks, at what point does that start to become negative for the equity market and not positive?
Well, if yields do move substantially lower from here, or even marginally lower from here, I think it is on weaker data. It is this narrative that, bad news is good news right now, but eventually bad news becomes bad news, right? When the economic conditions soften materially. It's normal, if you go back long-term in history, John, to see U.S. 10-years trade about 200 basis points north of CPI, of inflation, right? So even if you're going to assume CPI at 2.5%, right? You should have a 10-year around 4.5, maybe 4 3/4, somewhere in that range. We're where we should be right now. Above 5% moves from, I would call, restrictive conditions to punitive conditions for the U.S. economy. In this range here, I think we can live with this. But what's interesting is, if you take the narrative of the third quarter earnings season, you're getting 1 to 2 sales growth, so not really any top-line sales growth, and you're getting all your beats and sales growth on margin improvement, which means companies are being disciplined about cutting the expense line on the equation, but you can only pull that lever so long. Eventually, you need to see that pricing power take back over, which is a problem for inflation. And I would remind our listeners, if you simply looked at average hourly earnings and wage inflation, which doesn't have a lot of the recent increases in it, it's still running at 4.1% year over year, way hotter than the Fed wants it to be.
10-year right now, 456. Daryl Kelsey, stick with us going into the opening bell. About 20 minutes away, 17 minutes away. Your equity market slightly positive by 0.1%. With some movers going into the open. Here's Casey.
Well, let's start with Take-Two Interactive. It is soaring this morning after its division Rockstar Games said that it will release the first trailer for the next version of Grand Theft Auto in early December. Take-Two also reports after the bell today, so watch this space. Moving on, Rivian higher as well. After modestly boosting its production outlook, it also ended its exclusivity agreement to sell its vans to Amazon. Traders clearly see that as good news. Bad news, though, when it comes to Robinhood after earnings. Slow trading volumes led to a miss on estimates Fourth quarter guidance was a disappointment as well. You add it all together, Robinhood down about 7% pre-market, John.
Katie, thanks for that. Coming up on this program, annual debt interest costs could be topping $1 trillion in the United States.
The bond market, in some ways, is the risk asset, and the stock market is secondary. And set against the fiscal backdrop, I think it's altogether dangerous.
That conversation up next.
The bond market, in some ways, is the risk asset, and the stock market is secondary. And set against the fiscal backdrop, I think it's altogether dangerous. I'm not inspired by the fiscal dynamics. You mentioned numbers like $1 trillion in interest expense, and that's only going up from here.
The Treasury issuing a ton of debt this week, with $40 billion of 10-year notes today, $24 billion of 30-year notes on Thursday. This, as Bloomberg analysis shows, estimated annualized interest costs on the U.S. debt climbing past $1 trillion. The numbers could well get worse, likely reigniting debate about the U.S. fiscal path. Bloomberg's AMH joins us right now. Morning, Anne-Marie.
Good morning, John. Well, when you're looking ahead, it does look like when you see these yields rising on long-term treasuries, what this could mean is an escalating and bigger interest payments for the U.S. government. And I'd like to bring you what the Congressional Budget Office has already been putting out to talk about what the future is going to look like in terms of the U.S. federal budget. By the year 2051, Jonathan, paying our interest will be the biggest expense of the budget, ahead of Medicare, ahead of Social Security, ahead of our defense bill. And actually, when it comes to paying down the interest in just a few years, that's going to be a bigger share of the spending as opposed to the massive U.S. defense budget. So obviously, this potentially could cause some concerns on both sides of the aisle. And we're seeing some of this play out right now as we do see the House of Representatives try to negotiate some sort of way to keep the government open by next week. Come Saturday, 12:01 a.m., Jonathan, November 18th, the government may close if there's not a continuing resolution. And a lot of conservatives are saying that they want to see fiscal spending and fiscal discipline, and that's why they want appropriation bills passed, but doesn't look like there's going to be enough time for that. So potentially we'll get another stopgap. But this issue of long-term interest payments and that eclipsing everything else in our budget is starting to come back in focus.
AMH, thank you. The number's getting bigger. Let's catch up later on this. Kelsey Barrow, Daryl Cronk back with us for more. Kelsey, $40 billion, 10-year notes later, 30-year bonds tomorrow, $24 billion worth. Should I be worried about that at all?
Well, certainly the auction today and the auctions tomorrow are going to be a test of the market's ability to take down this much duration. And the trend that we've been seeing throughout the year is that the demand for treasuries has been shifting in terms of who's taking down that duration. It's shifting away from the price insensitive buyers like the Fed, like the banks, and moving towards more price sensitive buyers like asset managers, like we are, that are going to be more discerning about the yield and compensation that they demand to take on that additional risk, that additional duration risk. Now, I already mentioned that I was a bit skeptical about the path for the Fed funds rate, with the Fed funds rate never falling below 3.75% in the next 10 years. This plays into it. I think one of the reasons why the economy is going to be more fragile under a higher interest rate regime is also not just for corporations and for consumers, but also the strain that it puts on governments. We have a very difficult situation ahead. In the near term, we may be able to manage it. I think the auctions are probably going to be fine, but this obviously is going to be a focus in the coming weeks, in the coming months. And the challenge is that we know that markets really focus on what's just right in front of them. So we know those projections, that chart, interest expense is rising. But for now, we have to focus on just what the event is in front of us. We have the 10-year auction, the 30-year auction, and then, of course, the risk of government shutdown, which is difficult in its own way because we lose access to all of the data that the Fed relies on to make decisions.
A good friend of ours on this program, Rick Reeder of BlackRock, had this phrase that he used with me a long, long time ago. He said, we always focus on the shark closest to the boat. And this right now seems to be the shark closest to the boat. Daryl, in your mind, I'm sure you get asked about this from clients all the time. They ask you about the deficit. the debt dynamics, interest costs. What do you say back to them, Darryl?
Well, I would say a couple things here. I mean, the bid to cover has been good on the auctions. I think it'll continue to be good, but there's no doubt that banks, overseas buyers, and institutional buyers have been dented by poor fixed income returns on the long side of the curve, which are typically your duration buyers. So the mix is shifting. We'll see how well the market absorbs that. I would say this, John, 3 $1 trillion numbers, different numbers that you should have your eyes on. Certainly the interest cost going to $1 trillion, up from $399 billion on the CBO's estimates, is meaningful and matters going forward for the path of interest rates. Second, people forget that quantitative tightening now year over year has the Fed's balance sheet down almost exactly $1 trillion, right? So that's tightening financial conditions, and it's adding to bond market volatility, which is why we're seeing extreme moves here in interest rates, because the Fed's not an active buyer anymore through QE. In fact, they're letting things roll off. And the third one that people don't talk enough about is the $1 trillion of outstanding credit card debt that's out, that's out there, 1.08 to be exact trillion dollars. So $3 trillion numbers that matter here: interest costs, the Fed shrinking its balance sheet, and credit cards outstanding. At some point, those start to weigh on economic growth and opportunity.
Thoughtful stuff as always. Darryl Cronk, Kelsey Barrow, thank you. Sometimes the news is that there is no news. Mike McKee has the news that's no news. Mike McKee.
Jay Powell's text is out for his remarks this morning. I know the markets were looking forward to perhaps some sort of hint to monetary policy. Absolutely nothing in there. You can put that one aside unless you're really into the history of the Research and Statistics Division of the Federal Reserve. He gives a history lesson there. But tomorrow he does speak at the IMF with Gita Gopinath and with the Israeli Central Bank governor. And so that is an opportunity for him to perhaps push back if he wants to on the markets.
Mike McKee, thank you, sir. Looking forward to tomorrow. Coming up, the morning calls and later, stocks continuing to climb the wall of worry. Big tech looking for a 9th day of gains. Jay Pawlowski, TPW, coming up next. Equities drifting just a little bit higher, turning positive going into the opening bout. That's the price action. Let's get you some morning calls. Citi downgrading NXP Semiconductors to sell, seeing risk to estimates due to weakening demand. Mizuho downgrading Datadog to neutral, expecting limited upside after yesterday's monster rally. And finally, TD Cowen downgrading Estée Lauder to market perform, pointing to softening China trends and lingering supply chain disruptions. That stock is down another 1.4%. Coming up, stocks looking to extend their longest winning streak in 2 years. That conversation up next with TPW's Jay Pawlowski. Your opening bell is up next. We're 23 seconds away from the opening bow this morning. Good morning to you. Equities higher again on the S&P by 0.1%. 7-day winning streak on the S&P 500, 8 on the Nasdaq 100. Over the last 8 days on the Nasdaq coming into Wednesday, a move of more than 8 percentage points. Stellar rally going into the opening bell. There is your opening bell. Switch at the board and get to the bond market. Big move lower in yields off the multi-decade highs we saw a few weeks ago on a 10-year. North of 5%, back to about 450, 456, 66. The dollar stronger against the bulk of G10 through most of this morning. 106.73 on the euro against the dollar. That currency pair moving lower by 0.25%. We are going to talk about crude later in this show in about 15 minutes time. To see WTI in the 70s, a move lower of more than 10% in the month of October. We're back to lows we haven't seen since July. WTI crude $76 and about 70 cents. 30 seconds into the session, we're positive again. We had some more weight to the rally on the S&P 500, just 0.17% higher. One stock to watch at the open is eBay, the company delivering a disappointing outlook and sounding the alarm on consumers, saying this: we've observed softening consumer trends, suggesting we may see a more muted seasonal uptick over the holidays. Katie has this story. Hey, Katie.
And it's that grim holiday outlook that is sinking eBay shares this morning. Specifically, eBay sees sees EPS between $1 to $1.05 in the period ending in December. Obviously, a crucial period. Now, analysts had been looking for $1.05, so at the top end of the company's range. That's not good enough in this earnings season, as you can see in the shares right now. And like you said, the company was quick to place the blame on the macro environment, but this is also a story about losing share as much as it is about consumer health. Overall online spending in the U.S. is actually continuing to grow here, but eBay, it's battling the likes of Amazon, the likes of Walmart for those dollars, and that's an increasingly tall order. You add it together, shares currently off by about 7% or so, and negative for the year overall, John.
Katie, thank you. Not a great morning for them, that's for sure. Not a great year either. Katie, thank you very much. It's had two earnings stories in the auto sector. Rivian raising its production forecast, Lucid cutting theirs. The Rivian CEO saying this: "I just want to state how deeply convicted we are that the entire auto industry will be transitioning to electric over the next 1 to 2 decades." Simone, does he need convincing or do we?
Well, I think the real convincing is going to come in who is the follower to Tesla. Who's the front runner to be that follower to Tesla? At least in the earnings reports that we got after the bell yesterday, it looks like Rivian is far better positioned than Lucid to take up that mantle of number 2 EV maker. I mean, you look through these results, Rivian able to boost deliveries of for the year to 54,000 trucks and vans. That's up from 50,000 in August. It had already boosted that by 2,000 between then. Also, the company ending an exclusivity agreement on battery electric vans to Amazon, so now they'll be able to sell to other players as well. They're also going to do an interesting tech upgrade to cut manufacturing costs. The CFO saying these changes will, quote, position Rivian to exit 2024 with a much improved margin profile. Looking at a much more negative picture for Lucid, which makes luxury and electric vehicles, lowering its projections for the year in terms of deliveries to 8,000 to 8,500, down from 10,000. Not entirely unexpected, but investors have been really worried about some of the cash burn going on there, especially after it raised $1.5 billion in private debt last month. And the results here coming out not helping those concerns, especially at a time that electric vehicles are just a lot more expensive given high interest rates. So control of costs, staying on production targets, that is what is putting Rivian ahead this morning, and shares going in completely opposite directions here, John.
Hey, Simone, thanks for the update. Let's check out shares of Robinhood this morning and stick with earnings, reporting disappointing revenue as weaker crypto volumes drag down transactions. Shanali Basak has this story. Hey, Shanali.
Good morning, John. You are looking at crypto volumes really dragging down revenue over at Robinhood, but that's not just it. You also have options revenue lower than it was the prior quarter as well as a year ago, and equities also lower from a year ago. So transaction-based revenues really peaking here, just frankly, as the Dumb Money movie comes out. You have a lot of irony in the numbers here. You are watching the shares react to this, but Robinhood also reacting. Another thing I thought you would like is Robinhood here really diving into competition with the banks, with Vlad Tenev saying that they put a lot more value in products like Robinhood Gold, including a 4.9% annual yield on cash and a 3% match on IRA contribution. So the new excitement for the meme stock traders here, John, is earning some interest on their cash.
Have you watched the movie?
I have watched the movie.
What did you think? I enjoyed the movie.
I thought that it is too close to home.
Too close to home? I think it needed a little bit more depth, but that's us, I guess. That's the sort of Wall Street bias that you want a little bit more depth on those things. Shanali, thank you. It's a great movie. Check it out. Bit of fun. Let's stick on entertainment. Warner Brothers reporting a wider than expected loss due to an ongoing strike and weaker ad revenue. The CEO saying this: "We will focus on driving future growth and creating long-term value for our shareholders." Geetha Raghunathan of Bloomberg Intelligence joins us now for more. Geetha, what stood out for you this morning?
They actually had a really good third quarter, John. I mean, whether it came to streaming profitability, when it came to free cash flow. But I think what really concerned investors was kind of this gloom and doom outlook for 2024. So the TV ad market is cratering. It is down double digits, down 12% in 3Q, and there's just no signs on the horizon of a recovery, of a reversal going into 2024. And that's kind of weighing on their EBITDA outlook. That is going to weigh on, some of their leverage targets. So overall, it looks really, really challenging for 2024, and that's weighing on all of the media sector right now.
How does this tee up Disney after the bow a little bit later, Geetha?
Yeah, so I think the streaming, one of the things that we look for always with the media companies is the streaming profitability number. And of course, there is no streaming profitability just yet. But even if Disney can report narrower losses, I mean, that's a big win. So of course, any commentary there, and then just kind of in light of the Warner Brother numbers and the comments on the the challenges in the ad market, anything that Bob Iger has to offer in terms of how ESPN is holding up, how the rest of the assets are holding up, the TV networks, of course, that could kind of help assuage some of the fears, because right now, of course, everybody's very, very nervous about the health of the media landscape.
You and I have talked about this a few times already. What's for sale? What's not for sale? Geetha, over at the Walt Disney Company at the moment. ESPN, ABC, what's next?
So the linear networks definitely, I think, are very much fair game. Bob Iger has spoken about ABC, has spoken about some of the other linear networks like FX. ESPN, I think, is a little bit of a different story. They actually released standalone financials for the very first time for ESPN, suggesting that they are confident in the health of that business. I think, though, they're definitely looking for some kind of cash infusion with maybe a minority stake, maybe from one of the leagues, maybe from a tech giant. But I still think that they very much want to hold on to ESPN. I think it makes a lot of sense for them with that streaming bundle. They do have Disney Plus. They're looking to consolidate. Hulu get the 33% stake from Comcast. And so then to have ESPN Plus, a full-on bundle, I think definitely positions them very well in the streaming wars.
Geetha, we will catch up tomorrow following those numbers from the Walt Disney Company after the close a little bit later. If you're just joining us right now, 7 minutes into the session, equities advance on the S&P 500 for an 8th day. 8 days of gains on the S&P, 9 on the Nasdaq 100 right now, positive by 0.1%. TPW's Jay Pulosky weighing in on the 2024 outlook, writing this: while concerns remain about lurking rate-related risks, we see a global economy that has handled many notable ones already. Jay, I'm pleased to say, joins us right now. Jay, it's good to touch base with you as always and catch up. Let's talk about next year. I find it so difficult now to get beyond next month, never mind the next 12. But Jay, what are the reasons you've got to be more constructive looking ahead and looking out 12 months?
Well, John, we tried to do something a little bit different this year in our 2024 outlook. And so we focused on macro surprises, and we identified 4 of them, and I'll highlight 2 here. The first is we expect lower inflation sooner than expected, both in the U.S. and in Europe. And we'll give you a couple of reasons why. In the U.S., you have falling rents down year over year. You have gasoline prices falling sharply. You have used car prices down sharply. So the inflation picture, we think, is going to be better than expected, sooner than expected. That gives central banks room to cut rates, and that should support risk assets, which, when coupled with our second macro surprise, which we think, and plays right to your comment, a return to stability, right? People talk about all the problems, and I identified some in our outlook. And even today, reading this morning, one headline grabbed my attention. Fear is everywhere was the headline, right? We think we're entering a stable period in the global macro space. And I'll give you 4 examples. 2 economy related. One is retail inventories in the U.S., right back to normal, right bang in line. The second, supply chain pressures, which have been a huge issue since COVID, right bang in line. And then on the market side, believe it or not, the VIX has averaged 17 year to date, again, right in the 20-year average. And the S&P, John, the S&P year to date is within 1 percentage point of its historical average for the 3rd year in a presidential term. So we think this combination, lower inflation, faster than expected, return to stability, is going to unlock what we've called the $1 trillion reward. And that $1 trillion reward is the money that's gone into money market funds this year. Now I think it's up to about 1.5 trillion just this year alone that's gone into money market funds. Some of that money is going to come back and go into risk assets.
It sounds like a game show. Let me pick up on the first point. Inflation is going to drop more quickly and sooner than people expect. Can you give me a little bit more colour, Jay, as to why that's going to happen? Is that an improvement on the supply side or deterioration on the demand side?
Yeah, it's more the former than the latter, John. And one of the things that we highlight is that both the Fed and the ECB do not expect to return to target until late 2025. And we think we're going to be closer to 2% headline inflation in the US and in Europe by the end of 2024. So there's actually, the central banks have built in a lot of cushion in terms of what their projections are. So they'll be able to say next year, if need be, that, hey, we're ahead of schedule and we can now take a rate hike or two off the table, which is now being projected by the marketplace. And as we pointed out, John, supply chain is no longer an issue, right? Gasoline prices at the pump have come down dramatically. Used cars, that was a big issue in inflation the last couple of years. And most importantly for the US is that rents are coming down. That's a big chunk of the CPI. And we know for a fact that they're down over 1% over the past year. And that's going to feed into the inflation numbers with a lag. And that should be hitting here in the next 6 months.
I want to keep coming back to these 2 points you're making for your outlook, Jay. I think they're really important. One is ultimately you think inflation falls faster than people expect. And two, you think we return to stability. There was a great piece in the Financial Times in the last week, an opinion piece from Brevin Howard, the chief economist over there, who talked about the new abnormal, entering an era of higher and more volatile inflation. Where is that stability, Jay, coming from? And what is it about where we are right now that makes you believe we can head back to the pre-pandemic conditions of several years ago?
Well, it's actually, we don't expect to go back to the pre-pandemic of low inflation and low growth. We think that 2010 to 2019 period was an aberration. Going forward, longer term, John, and you and I have touched on this in the past, we're believers that we're in the early stages of a global CapEx boom to deal with what we call the 3 C's of COVID, climate, and conflict, which is really reshaping the global supply chains into regional supply chains, which fits right into our tripolar world framework of regional integration in Asia, Europe, and the Americas. And we don't see this as an abnormal. We see this as the next step in the global evolution of how economies and markets are going to perform. So one of the ways we play this as an investor is we're looking for opportunities in some of the emerging market space where they are being integrated into these big 3 regions. So think about Mexico in the Americas. Think about Poland in Europe. Think about Indonesia in the Asia Pacific. So we see some really interesting opportunities. And by the way, the rest of the world not only offers growth potential, but is valued at a 20-year low relative to the U.S. and relative to their own history. The rest of the world is on a significant discount to where it has historically been. And that's where we really see the opportunities, in part because that lower inflation stability leads to a weaker dollar. And the weaker dollar, John, is really the global macro key as we see it.
Jay, I've been sitting next to Lisa all morning. The bullishness is just jarring. It's overwhelming. Jay Pawlowski at TVW. Jay, appreciate it. As always, mate, it's good to catch up. Very bullish, constructive. The bulls sort of standing taller after the move we've seen over the last week, that's for sure. 8 days of gains on the S&P 500, up by 0.2% on my screen right now. Coming up, crude flirting with multi-month lows despite the war in the Middle East.
Things can suddenly change very quickly, both in the Middle East, towards a negative, towards a positive. So that can really shift things.
That conversation up next.
The market is preparing in case something were to happen. Things can suddenly change very quickly, both in the Middle East, towards a negative, towards a positive. So that can really shift things. The market is waiting for evidence that actually we have tightness led by these supply cuts and demand isn't waning. Whereas, on the other hand, if it continues waning, then we could see further falls in price.
Crude prices edging towards a 4-month low, even as the war continues in the Middle East. G7 foreign ministers ramping up the pressure on Israel for a pause in the fighting, writing this: "We stress the need for urgent action and support humanitarian pauses to facilitate urgently needed assistance." Israel's Prime Minister Benjamin Netanyahu remaining steadfast, saying this: "There will be no general ceasefire in Gaza without the release of our hostages. Your team coverage starts right now with Bloomberg's Anne-Marie in Washington, Will Kennedy in London. AMH, that pressure continues to build.
The pressure is palpable, Jonathan. This is on the heels of Axios reporting that on Monday, President Biden, in this phone call with Prime Minister Benjamin Netanyahu, talked about a 3-day pause to allow the facilitation of this dialogue to release those hostages and also to get humanitarian aid in. And then we see this morning on the sidelines of this G7 meeting that Secretary of State Antony Blinken is in Tokyo for, not just a statement from the G7, but he also came out and spoke about it alongside some of those others, foreign ministers from the G7, that there has to be a pause to allow this humanitarian aid in. But also notably from that interview with ABC News, Netanyahu, with the Israelis saying that they do not want to reoccupy Gaza, he is talking about an indefinite period where they need to have the security control of Gaza. So right now, Jonathan, there's a lot of pressure from Biden alongside other G7 countries to get some sort of pause to allow that humanitarian aid in and a dialogue for hostages.
And Will, then you look at crude and you're expecting higher prices and you've got lower prices. Will, just to go through the numbers together, you and I have been doing this now for a long, long time. To see what we've seen in the last month, we were in the 90s in October. Then we had a move lower of close to 11% on WTI. And now, Will, we're back in the 70s. Will, what's driving that?
Well, I think that a lot of people got long because of the war, and there was obviously that concern that it would spark a wider conflagration involving Iran. And I think that traders are now a bit more confident that won't happen, and they're looking again at the fundamentals of supply and demand. And while demand is broadly pretty robust, I think there's some concern about how the economy develops next year. There are some signs of weakness in industrial economies in particular, and supply remains pretty strong. We're getting more oil out of South America, Guyana and Brazil. Shale has probably performed a little bit better than people were expecting at the beginning of the year. And while Saudi Arabia is keeping its production down, there's been quite a little bit more oil out of Russia in recent weeks. And you put all that together, and suddenly the fundamentals, when you strip away the war risk, aren't as strong perhaps as they have been.
Just off session lows at the moment on my screen. AMH, Will, to the both of you from Washington and London respectively, thank you. Brent crude $81 and about 30 cents. Brent crude's down about 0.4%. WTI a break of 80. We're in the 90s, come all the way back down to 70s. 76.93. We're negative this morning by about 0.6% on my screen. The broader price action, about 21 minutes into the session, 8 days of gains on the S&P, make it day 9 on the Nasdaq, up 0.25% on the S&P 500. Let's get you some sector price action. Back with us is Casey.
You take a look at the sectors right now, you have 8 positive, 3 negative on a pretty quiet day for the overall benchmark. You take a look at what's leading gains right now. It's real estate up at the top, up about 0.7% or so. Big tech also having another good day. Industrials, materials also getting in on the action. That's the good news. You go down to the bottom of the screen. Not too much to pick at here. Of course, communication services just slightly negative. Utilities, though, having a pretty bad day so far, off by 1%. For once, energy is actually sitting on small gains. But as you were just discussing, it's been a rough couple of days, a couple of sessions, a couple of weeks really for the energy equities as you continue to see oil fall out of bed here. The energy index off by about 1.3% over the past 5 days. For the month of November, John, this is interesting. It is the only sector negative out of 11 in total.
Katie, thank you. For once also, I'd say this. Things are quiet in the bond market. Just in terms of the price action, 10-year yields not doing much, down a single basis point, 455. Had some comments this morning from some people in the market. The primary market really, really hot on both the credit side, and you'll get some more Treasury issuance, of course, a little bit later. I'll give you a sneak peek of the numbers on what to expect from the Treasury for a 10-year and a 30-year through the next 24 hours. We'll do that next from New York City. Your trading diary coming up. I feel like a broken record. I've said it so many times already this morning, but here we go again. The longest daily winning streak going back 2 years, November 2021. It's day 8 on the S&P 500. Day 9 on the Nasdaq 100. It's a lift once again this morning by 0.3% on the S&P. On the Nasdaq, up by around about a third. That's the price action in the equity market. Let's get to the trading diary. Next couple of days look a little something like this. The US Treasury selling 40 billion of 10-year notes at 1 p.m. Eastern time. You'll hear from Williams, Barr and Jefferson. The Fed speak throughout the afternoon. Disney reporting earnings after the closing bell. Thursday, the Treasury sells $24 billion of 30-year bonds. The Fed speak continues with Bostic, Barkin and Chairman Powell as well. Look out for all of that in the next couple of days or so. From New York City, that does it for me. Thank you very much for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.